Welcome to RBC's Markets in Motion podcast, recorded March 9th, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we review the results of a survey we conducted of RBC's U.S. equity analysts on the conflict in Iran last week, which helps explain the resilience we've seen in the S&P 500. Second, the valuation and sentiment barometers we're tracking do point to room for further downside in the S&P 500 in the near term, in absolute terms, while our work on U.S. valuations versus other global developed markets highlights why the U.S. equity market has been embraced as a safe haven, helping outperformance versus global peers to reignite. If you'd like to hear more, here's another 5 minutes. Takeaway number 1. The analyst survey we conducted last week helps explain why U.S. equity markets have been so resilient amid the Iran conflict. We asked our U.S. equity analysts to assume the conflict endures for more than 4 weeks and that oil stays above $100 for an extended period of time. We then asked them to indicate impact to EPS from higher oil and gas prices, the revenue impact due to exposure to the Middle East, and the overall impact from knock-on effects. 3 key findings. First, fundamental risks to the U.S. equity market from a worsening of the conflict are concentrated in certain areas and seen as low overall. Among our non-energy analysts, 72% said that EPS impacts from higher oil and gas would be none, only a little, or not relevant, mixed, don't know. The same was true for 77% when we asked about revenue impact from the Middle East, and 66% when we asked about the impact from knock-on effects. Does this data suggest a worsening of the conflict doesn't matter to U.S. equities? No, but it does suggest that risks are concentrated in certain areas, and that in many the potential impacts are just not seen as highly significant. Second, communication services, financials, healthcare, and utilities stand out as some of the most insulated sectors from a worsening of the conflict. Almost all of our analysts in these industries replied to each of our questions regarding impact with none, only a little, or not relevant, mixed, don't know. On the flip side, consumer staples and materials were seen as most impacted, though it should be noted their answers were mostly in the some a decent amount category as opposed to a lot on all 3 of the questions we asked. Third, inflation and consumer confidence were the top knock-on effects highlighted. Next in line were demand issues, fuel prices, supply chains and transportation costs, and various issues related to a defensive tone or risk-off bent. We found it interesting that inflation and consumer confidence, 2 problems U.S. equity investors and public companies have been contending with at various points in the post-COVID era, have been mostly in focus in terms of the challenges that this crisis presents. This may speak to the idea that the ripple effects of the conflict are a worsening of ongoing problems that can be managed. Pivoting to takeaway number 2, signals from our valuation and sentiment work on the broader market. In last week's podcast, we highlighted several sentiment and valuation barometers we're watching that have helped us gauge when periods of stress have gone too far in recent years in absolute terms for the S&P 500. None of them are signaling an end to the current moment we're in right now. Net bulls on the AAII investor survey did move up last week. We think a further erosion of sentiment would have been healthier for stocks. We're watching for a move to 1 or 2 standard deviations below average. Meanwhile, the S&P 500 bottom-up market cap next 12 months PE has moved down to 23 times, but remains well above its average of 18.5. In 2022, this version of the PE fell slightly below average at the market low. And the Russell 2000 FY2 PE, which fell below 13 times at the lows of the major drawdowns of 2022, 2023, and 2025, is back down to 16.1 times, but still well above the average of 15.2, and not close to the 11-13 times range, which tends to be seen in recessions. When we look at valuations through a different lens, however, we gain an appreciation for why downside has been less severe in U.S. equities than most global developed markets peers. Our global valuation charts highlight how the FY2 PE of non-U.S. developed market equities has moved up sharply of late, both in aggregate and a number of different countries. And when we look at the U.S. relative to non-U.S. developed markets, the relative FY2 PE has come back down to levels close to the long-term average and to levels below the 5-year post-COVID average. We think this opened the door for the geographical leadership trade to pause at a time when investors were looking for safe havens. This in turn has helped the megacap growth trade in the U.S. start to outperform again. As we've highlighted before, when the U.S. underperforms non-U.S. equities and Europe in particular, growth tends to outperform value in the U.S. as well. In general, we think the rotation trades from growth to value and large to small that had been underway in the US are on pause as long as Middle East tension remains high. In the case of small caps, this isn't just about safe haven seeking. Some of the earnings related data points that had been looking better in small cap than large cap recently have slipped. And Friday's week job report also argues against small cap outperformance for now. And one final thought on the market before we wrap. We stress tested our valuation and earnings model for a worsening of the Iran conflict. We baked in 3.6% headline CPI, the output of a stress test our econ team did recently on $100 oil, a flat Fed, and 10-year yields of 4.5%. We put all that into our trailing PE calculation for 4Q26. We took the stat the math produced, 23.76 times, and married it up with a 292 EPS assumption, which is a 5% growth rate year over year, similar to 2022, and a 278 EPS assumption, flat EPS with 2025, a similar dynamic to the 2015-2016 industrial recession when earnings went nowhere for several years. This math produced a fair value range for the S&P 500 of roughly 6,600 to 6,900, in line with where the S&P 500 has been stuck recently. This suggests to us that the index may already be baking in some stagflationary consequences of current events, though not recessionary conditions. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.